Hello, everyone. Welcome to the weekly roundup. Today, we will cover GDP, interest rates, taxes, and market sentiments. Hello, Ben.
Hey, Eva.
How was your Canada day?
Really good, really good. Nice to have a nice day. Weather was good, so it was all good. How about you?
Good. Saw the fireworks. Really pretty.
That's good. That's good. I heard they're a little shorter than usual this year, but I heard they're nice.
Yeah, very nice. This was my first time seeing them, uh, so it was quite a watch.
Awesome.
Okay, let's get into it. Canadian GDP came in lighter than expected. This was largely due to the impact of tariffs. So what are we expecting going forward? Are the recession fears resurfacing? Should we be looking that way?
So I think it's a good question, good point. I mean, I think GDP continues to be challenged, and you can look at seeing how the Canadian economy is tilting away from the U.S., the reliance on the U.S., and it's a big ship. It takes a lot of time to move and repoint and take a new direction. I think that the central bank probably is going to look at it quite a bit more closely. I think we're something in the neighborhood of 40% probability of a cut right now for July 30th. So we'll see how that evolves. But if the data continues to come in soft like this, then I'd say the increasing likelihood of a cut in July starts to grow. I mean, our economics team, and I think I mentioned this last week, still has 75 basis points on the table for this year with a hope for a cut in July. Whether it actually happens or not, I guess we'll see. And so, but if GDP keeps slowing, unemployment keeps rising, inflation keeps slowing, those are all a recipe for rates coming down. The housing market in the major cities, it's a ex Ottawa, have continued to slow as well, quite dramatically. So all those things kind of pointing towards slowing activity, resulting in likely lower rates. But your question around what does it mean from an overall economic perspective? Do we have a recession? I guess we'll see. Too early to say, but certainly the direction we're heading is to negative GDP this quarter. And what's that look like in the quarter after that? I think will largely be decided on based on the direction of rates at this point.
Okay. So on the US side, there's been some mixed economic signals. There's some growing speculation around yield curve control. What's the outlook for US rate cuts in the second half as well?
Yeah, so today we had a jobs number in the US come in ahead of expectations. So we had 147,000 jobs added, with consensus was around 110 or so. So I'd say that's a positive, but a mild positive, rate of change positive. But from a big picture, that's still not a lot of new jobs being added to the system. Um, to the question around what does it mean for rates in the US? It's a great question, and I think that why we reference yield curve control. It's something that Japan did for decades, and yield curve control is effectively government intervention in controlling yields. And so, if they decide that the 10 years got to be at 2%, then they peg it at 2%. Anytime it slips over and above that, they get into the market and buy. Anytime below that, they sell. And so their objective is to maintain certain levels in order to, we'll say, direct the economy to some extent. And so, where the central banks have had the ability to rely on ebbs and flows, inflation would kick in, they get some uptick in unemployment, they'd start to worry about the economy, they'd have the ability to cut rates. And now we're in a bit of a more difficult environment now where they may need to intervene. And so we had a period where Ben Bernanke did this Operation Twist, which was sell short dated and buy long dated to flatten that yield curve. So I think we could see some more of that, and I think that's part of why we're seeing U.S. dollar weakness. Is you're starting to see that bubble to the surface. And if the world's biggest economy and the world's reserve currency decide to go to yield curve control, that's a material thing that we need to think about because it'll have major knock-on effects to other assets.
Okay. In the past 1 week, there has been a wave of tax-related news. from Canada's reversal of digital service tax to some US tax reforms. I do know we're not tax experts, but what should investors know and how could this affect their portfolios?
So the point around the digital tax, that was, Canada was one of the few countries that said they were going to do retroactive tax. And so they said they were going to tax Google and Amazon and Meta and all these companies that were operating in Canada but not paying the revenue or the tax back to the Canadian government. And so they said they were going to do a retroactive 2022 until Monday of this week tax, and that was going to be a couple of $1 billion. And so, I mean, from a big picture, it's a drop in the bucket to those companies. But from a longer term perspective, that's pretty negative for Canada US corporate relations. So the Canadian government decided to kibosh that in hopefully an efforts to have some goodwill towards President Trump and their negotiations for a new NAFTA, USMCA, whatever they want to call it. And so I'd say that was a mild positive. Um, the bigger picture, I guess, for Canadian investors was in the big beautiful bill that's looks like it might pass here. There were going to be punitive taxation on owning U.S. assets, and so right now we have a tax treaty with the U.S. So if you own U.S. stocks, you only pay 10% instead of 25% on those dividends that you own. You're able to own those assets in our registered plans or RSPs, not all registered plans and RSPs, and not pay any of the withholding tax. So we do have a preferential tax relationship with Canada and the US, and that was looking to get tossed aside. He did remove that from the bill, and so that also is quite a bit of a positive because we've been trying to say, okay, what do we do now? If they decide to increase the taxation, you're already starting with a 25% haircut on those dividends. So you're better off owning maybe international stocks or Canadian stocks versus US. And so that being removed certainly has helped the investment decisions.
Okay. So we're in the second half of the year. Yay, we survived.
Yes.
So what are your expectations for Q3 in terms of trading sentiments, general market leadership? What do you expect to see?
Yeah, so we finished the first half of this year, obviously volatile period where we had April, which we went in. I think we slipped into intraday bear market briefly by the S&P. So we had a quite a volatile April. Then we had pretty good couple of months and ended the first half in good shape. And so, what do we do at this point? One of the things that happens when you get a big fall or a big market shock, we'll say you get volatility spiking. And so what's been transpiring since then has been volatility has been falling and falling and falling. And so now we're starting to get back to reasonable volatility levels, starting to get back to kind of looking at, you know, I'd say a bit more normal market where there's like volatility's down, daily trading, you're not seeing 1-2% swings in the market. And so you've seen a lot of the kind of the risk in the market fall down. And sentiment is starting to lean a little bit more to the optimist side. And so, I'd be looking at it and saying, okay, does this mean that we're done the current run, or is there maybe something else to it? And just when we look at some of the sentiment indicators, which I'll show in the charts, you'll see that, there's probably still some more upside ahead in markets. And a lot of that's going to be driven by flows as opposed to economic activity. And so I'd be watching and continue to watch flows and money supply, some of the things that we talked about earlier this year.
Yeah, good. Let's see the charts.
Okay, we're recording this on Friday, July 3rd, and US markets just closed a little while ago. 1 o'clock early close today, and certainly be closed yesterday for the 4th of July. So anything that is discussed after 1 o'clock today, we'll comment on next week, of course. And so, as I mentioned off the top, US dollar continues to be a major linchpin as to what happens from here. And so, we've seen the US dollar really fall off quite dramatically since President Trump won. And a lot of that has to do with what's going on trade, tariffs, not as much need for US dollars, many moving parts here. However, a weak dollar results in a strength somewhere else. So, you've had a strong euro, you've had a strong Swiss franc. You've had other currencies, the Canadian dollar even has been strong relative to the US dollar. So this US dollar weakness we'll have to continue to watch and say what happens from here. Do we get a maybe a mean reversion where you get a bit of a bounce in the US dollar, or do we continue to see some capitulation here and the US dollar sells more? Who are going to be the benefactors? As I mentioned, currencies, maybe gold, maybe some other asset classes. So we'll continue to watch how the US dollar moves from this point. But I think when there, and if there is, I would say, a big global resolution on trade and tariff, you probably get a mean reversion trade at some point. Not saying it's tomorrow, but certainly something we need to be conscious of at this point is what happens to the US dollar. So I put this up a couple of times. Speculative positioning, always like to look at this, and this gives you an answer to some of the questions around what do you think happens from a total positioning perspective. And so if you look at here along the top here, we have the S&P net positioning. So net positioning continues to be on the negative side of things, which means that let's say non-commercial speculators are underweight the S&P is what this is telling you here. And so the market can continue to move higher at this point, given the positioning of portfolios. So, you get this trade start to swing in the other direction where the S&P keeps moving higher. That's going to put pressure on people that are short the market, which is what the report's telling you here. So that's interesting. So maybe some more upside here in the S&P and something worth paying attention to. Which I commented on last time continues to be US bonds. And so when we do, and if we do see that change, which I think we will, you get massive short positioning on the 5-year US bond. And so, if we do get a yield curve control and you get intervention by the government says we're going to peg the 5-year at 2. This is a huge beach ball underwater where you could get a pretty material rally in US bonds. And so I think it's important to continue to pay attention to. My biggest view would be look at the 2 to 10 year. That's where you get most of the short positioning. Out on the long end, on the super short end, pretty neutral. So not much in the way of material swings happening in those areas. But that 2 to 10 year US bond is something I continue to watch quite keenly. So always love this chart, thinking about positioning and how the world is thinking about where the potential risks and opportunities are. And what's ahead in July? So, as you mentioned off the top, Eva, you're asking about what's going on with the economy, what could change between now and then. So, if we look here on July 30th, that's a big day because that is a U.S. Meeting at 2 o'clock, and you have the Bank of Canada at 9:45 in the morning. So, between now and there, though, we have to cover a few things. As I mentioned today, we had U.S. Payrolls. As we look into next week, we got small business optimism, always interesting to look at. We have consumer credit, which is worth paying attention to. Over here next Friday, we have unemployment and building permits in Canada. So there's plenty of data that can ebb or flow with the change to interest rates at this point. And so I'd be watching these days over the next 2 weeks to see what's going to happen on July 30th. Right now, the market's saying not likely rate cuts, but if we continue to see deteriorating economic activity and deteriorating inflation, the probability of a rate cut starts to increase quite materially. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. You have any questions or comments, please feel free to reach out to me or your investment advisor, and they'll be happy to answer any of those questions. As always, please consult your advisor if you want more details on anything we discussed today.
Oh, there you are. So I have one last question. I do know that we started to see some earnings. Is there anyone worth noting for this meeting?
There wasn't anything that jumped out at me yet. Early days on earnings, and so those numbers will be worth watching. Be continue to watch the financials both in Canada and the US. And so in Canada, they report at the end. In the US, they start to report quite quickly. So I'd be watching loan loss provisions because if you look at debt, which we've looked at in both Canada and the US, consumer debt in the US is trillions, like 10, I think we're looking at close to 20 trillion now, where Canadian consumer debt's around 2 trillion. So you're watching loan loss provisions for the financials. And I think that I guess the one area I'd maybe watching would be the telecoms and the utilities and seeing how they come out because rates have been coming down. Has that been a positive or a negative for those businesses? But generally, no, just be interesting to watch and track the numbers and see what happens from here.
Okay. Thank you, Ben. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeat newsletters will be in the caption of the video and also in your email box. For our clients, please reach out to me if you have any questions or if you'd like to book a portfolio review meeting with Ben. Thank you, everyone, for listening and have a good day. Bye.
Thanks, everybody. Take care.